Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is Cameron Mealy. Today is November 4th, 2024, the day before the election. We could have waited till after the election before, but today we decided let's focus on what happened in October. We'll see what happens tomorrow and Wednesday, and
maybe Thursday, maybe Friday, maybe Saturday.
Go from there.
Sunday.
So what we do know what happened is what happened in October. We'll talk about that today. Latest economic numbers, how the portfolios performed, and then some thoughts on what to expect once we get past the election noise. Cam, kick it off with some economic numbers.
Will do. Thank you, Kelly. And good morning to everybody. Let's focus on some of the numbers we traditionally talk about. It's been, I wouldn't say a mixed bag. Inflation certainly looks like it's coming down. GDP has remained soft, but then we got an absolutely horrific jobs number in October. There are some... we can put an asterisk next to that jobs number because we have had a major strike at Boeing and two major hurricanes, which have not really affected jobs per se, but affected the government's ability to survey different companies that are operating in some of those areas that have been hit hard by the hurricane. So let's jump in first to GDP. On October 30th, the Bureau of Economic Analysis reported that according to its advanced estimate, GDP in the third quarter increased at an annualized rate of 2.8%. And you'll remember that is a little bit down from the 3% that GDP increased in the second quarter, but still 2.8% is a really strong GDP number for the U.S. economy. If we look forward for the fourth quarter, as of November 1st, the Atlanta Fed's GDP Now forecast model is predicting the fourth quarter GDP will increase at an annualized rate of 2.3%. So from 3% to 2.8% to 2.3%, obviously that does show a pattern of a little bit of a slowing, but it's still very strong GDP numbers.
2+% GDP growth is, that's kind of normal. I mean, that's kind of the natural growth rate.
Yeah, so slowing from an accelerated standpoint of GDP.
It was looking a little hotter. Third quarter didn't quite come in as hot as people may have expected, but still, we're not shrinking. It's just maybe slowing down a little bit, but that's kind of what the Fed's been trying to do.
Exactly. And speaking of what the Fed's trying to do, they are trying to fight inflation right now. So let's look at the three major gauges of inflation that we've had come out over the last month. First, the Personal Consumption Expenditure Index. This is what a lot of economists say is the Fed's leading gauge of inflation. On October 31st, the Bureau of Economic Analysis reported that Personal Consumption Expenditure Index increased 0.2% in the month of September. For the 12 months ended September, the index is up 2.1%. So now we've seen the Personal Consumption Price Expenditure Index really declined from 2.7 in March and April of this year, 2.6% in May, 2.4 in June, 2.5 in July, and 2.3% in August, now down to 2.1%. So certainly paints the right picture what the Fed is trying to see in terms of trend.
Yep.
Let's look at the Producer Price Index. On October 11th, the Bureau of Labor Statistics reported the Producer Price Index was flat in September. On a year-over-year basis, the index was up 1.8%. This result compared with an increase of 1.9% over the 12 months ended in August. So again, not much of a trend going from 1.9% down to 1.8%, but flat month over month. Certainly that's an encouraging sign from an inflation standpoint. Let's turn now to the third number, the Consumer Price Index. On October 10th, Bureau of Labor Statistics also reported the Consumer Price Index increased 0.2% in September. This was after falling 0.2% in August, and on a year-over-year basis, the index is up 2.4%. So that is a little hotter of a number than what was expected by economists on the street, but still not a bad result considering 18 months ago we were looking at 9% year-over-year inflation.
No, my takeaway is we've gotten through the summer. Typically, you get a little summer some kinds can be depressed inflationary numbers. They haven't re-accelerated. We're in that, low to mid twos on inflation. Not too bad. We've made a lot of work from that 9 number. I'd say that's definitely encouraging, and it looks like, for the time being, the direction is going the right direction.
And really, that means
inflation.
Based on what the Fed wants to do, they really want to have rates equal inflation, which means they could bring rates down another couple hundred basis points to a 3.5% level and still feel very comfortable with that number. I'm not saying that's what they're going to do, but that's theoretically in their mind trying to match rates and inflation. they've got some room now where they can certainly justify bringing down the Fed funds rate.
Right, and a lot of it's just getting rates to be more normalized and rational, which, a short-term rate at 3.5, if we're in this type of inflationary environment, probably makes a lot of sense. So that's kind of the path we're on.
So let's turn to the one number that, is the biggest disappointment, as we alluded to. GDP has been strong. Signs of inflation are coming down. But let's talk about the October jobs report. Jobs report was expected to be weak as a result of the Boeing strike and two major hurricanes. However, as reported by the Bureau of Labor Statistics, the U.S. produced a disappointing 12,000 non-farm payroll jobs in August, significantly missing the consensus estimate of 112,500. And this has been the weakest now jobs report since the U.S. lost 243 jobs in December 2020 due to the COVID shutdowns. So GDP strong, inflation coming down. The jobs report, again, two hurricanes, a Boeing strike. Really hard to get a hard read on that. We'll see how that number is revised. But certainly that's a disappointing number. We do have the Fed meeting now, November 6th and 7th this week. We'll have a presidential election tomorrow, the Fed meeting Wednesday, Thursday. I think the Fed certainly is justified if they want to bring rates down another 25 basis points. This jobs report, I'm hearing a lot of people say over the last couple of days, maybe that pushes them to another 50 basis point cut. But in my opinion, it's really hard to cut 50 basis points when GDP
to make a decision,
still pretty strong.
To make a decision is based on what happened during that time frame. It's you got a lot going on with how it's reported and how accurate is that number. Why would you make a Fed cut decision on it? We'll see.
Yep.
Maybe they cut 25. I mean, the smart play would be either do nothing, hold off a month or so. Nothing's going to fall off a cliff in a month or so, but hey, I wouldn't go too heavy on it. But the trend is definitely going in the right direction. We're getting a little bit of normalization is really what we're looking at.
Yep. So that's all I have, Kelly.
Okay, so I guess, big picture, things aren't that, the economy's decent. Rates are normalizing, I'd call it that. I'd call it normalization of rates. Unemployment's a little gray just because of what we had happen over the fall with the hurricanes and the union strikes.
And we have what could be the most contentious election in U.S. history tomorrow. Will we know who the president is in 24 hours?
I'd say unlikely.
No idea.
Definitely unlikely. That is definitely going to cause some volatility in the market. Yep. And frankly, I think that's what caused a little bit of the volatility we saw late in October. October, it's a negative month. We haven't had a negative month for, I think, since April. So we've got a good 6 months without a negative month, which is, fairly unusual. That's not normally what happens in the market. For the month, the S&P 500 was down 0.99%, so almost 1%. The Dow Jones down a little bit more, down 1.34%. The NASDAQ down 0.52%. The Russell 2000 down 1.49%. The MSCI EAFE, which is the international market, down 5.5%. So international markets definitely took it on the chin this month. Emerging markets down 4.38%. In bonds, I mentioned before, we're getting a normalization of interest rates. The 10-year Treasury is now in that 4.2, 4.3 range. We were actually in the high threes a couple months ago. So that's definitely hurt long-term bonds down. The Bloomberg U.S. Aggregate Bond Index down 2.48% for the month. Year-to-date, though, the S&P still up 19.62%. Dow Jones up 10.81%. NASDAQ still up 20.54%. Small cap stocks measured by the Russell 2000 up 8.37%. International markets, the EAFE up 4.33%. Emerging markets up 9.36%. And overall, though, the aggregate bond market up 1.86%. So, yeah, it was a rough month. We were due for one.
Yep.
It didn't happen in September. It happened in October this year. But October has passed us. And, from a market standpoint, obviously things could get messy these next several days. I expect, you have to expect volatility, but maybe some of that's behind us. And, this has been dragging for a couple of weeks.
Yep.
Wall Street tends to lose its patience over these types of headline things. I think the market moves beyond it by the end of the week. And then it's more about what's actually going on. In
Fundamentals. Let's get back to fundamentals. But I'm sure all of our clients, just like all of us, cannot wait, no matter what happens, for this election to be over. It's all we hear about. It's all we talk about. It's all we get text messages and emails on. Good riddance.
Yeah, and whoever gets elected is not really going to affect those fundamentals. That's the reality. Not much is going to change, a little bit on the margins, but in general, the economic fundamentals were kind of on the path for going on. And that's really being driven by the Fed. And it's up to the Fed to kind of be patient in, making their interest rate calls, I guess, well thought out and not getting too drastic based on short-term news is really the key. Our portfolios during the month, dividend yield down to 1.5% for the month. Year-to-date, we're still up 14%. Blackstone was a gainer, up 10%. Packaging Corp up 6%. Paychex up 4%. Not big numbers because obviously it was a down month. Laggards, Merck was down 10%. Dow Chemical down 10%. General Mills down 7%. Year-to-date, though, Packaging Corp still up 43%. Southern Company up 33.5%, which we did step away from just last week. Blackstone up 31%, and Caterpillar up 29%. Year-to-date in this portfolio, UPS down 12%, LyondellBasell down 5%, Merck down 4%. In our growth to income portfolio, or growth with income portfolio, October we were down 1% there. Year-to-date, we're still up 14%. During the month, NVIDIA had a big bump up 9%. I think some of that may have been the anticipation of going into the Dow. Visa up 5% for the month, and our gold position up 4%. So gold's been working out pretty well. Laggards, Aptiv down 21%. That was a tough hit there. Nike down 13%, and Sony down 9%. Year-to-date, NVIDIA is still a big winner in the portfolio, up 168%. Iron Mountain up 81%. Raytheon up 46%. Berkshire Hathaway up 26%, and Exxon up 20%. Year-to-date, Aptiv leading the pack after that loss this month, down 37%. Nike down 28%. Nucor down 18%. Appreciation with income for the month was down 2%. Year-to-date, we're still up 18%. So still a pretty solid year. Philip Morris up 9% for the month. Kinder Morgan up 12% for the month. Equitable up 8%. October laggards, AES Corp down 18%, Bungie down 13%, Public Storage down 10%. Big gainers in the portfolio, Philip Morris up 47% for the year, Equitable up 39% for the year, JP Morgan up 35% for the year. On the downside for the year, Mosaic down 27% and Bungie down 24%. Price potential, once again, continue to struggle with this portfolio. We've been making a lot of changes the last couple of weeks, so hopefully we can finish strong. October, we're down 5%. Year-to-date, we're only up about 0.5%. For the month, year over year, we're still up about 12%, but these first 10, 11 months have been pretty weak for it. Big gainers, Air Products up 5%, Google up 3%. Sent down on the downside for the month, Centene down 17%, Genuine Car Parts down 18%, Charles River Labs down 9%. Year-to-date, winners in the portfolio, Allstate up 35%, Arch Capital up 33%. In our small cap portfolio, everything else was down. Even the index was down, but in the small cap world, our small cap portfolio up 1.5% for the month, so pretty solid in small caps. Year-to-date, we're up 22%, so one bright spot there. October gainers, Argan up 31%, Northeast Bank up 15%, U.S. Lime and Minerals up 15%, Zoma up 14%. Zoma was kind of a quick turnaround over a couple of weeks. October laggards, Transcat down 21%, and Steel down 12%. International Seaways down 16%. Year-to-date, still in the portfolio, IES Holdings up 176%, U.S. Lime and Minerals up 145%, Sterling Infrastructure up 76%, Northwest up 48%. Really, all the laggards, really nothing that's down major year-to-date that we haven't got rid of out of the portfolio, so pretty good there. So that's kind of how things played out last month. Like I said, expect some volatility the next week or so, but I think the setup is good into the end of the year. I will go on a limb and say things will be higher at the end of the year than where they're at now, and probably a decent amount. I think we'll at least revisit our highs, if not exceed our highs that we've seen so far.
Yep. And for our clients that have retirement accounts, we'll be processing required minimum distributions over the next couple of months, also looking where we can harvest some tax losses. So as always, we only have 2 months left in the year. If you have any questions, you want to review your accounts, please feel free to let us know. And have a great day, and we'll talk to you again in a month.
Thank you.